Good evening, everyone, and thank you for joining us. We will begin shortly. Good evening, everyone. My name is Ryan Keene, Vice President of Lending at Arden Credit Union, and thank you for joining us for our latest virtual workshop, Home Buying for Rookies. Arden has hosted several virtual workshops over the last year, and occasionally technology will throw us a little bit of a curveball. We do ask for your patience if we experience an issue, as I'm sure we'll have it fixed quickly. Lastly, we do understand that the last 12 months have been challenging for many of our members, so we do encourage you to please don't hesitate to reach out to us if there's anything that we can help with, whether it's from a loan or just an account-related question here at the credit union. If you need to ask a question during the workshop, please click the Questions tab and type in your question. The photo to the left is the screen of an iPad, and the photo to the right is the screen of a desktop. We have Lisa from Arden's marketing department on the line who will relay the questions to our speakers during the Q&A session at the end of the presentation. Please note that this workshop is being recorded and will be posted on Arden's website within the next few days. Arden's First Home Concierge is a free service designed to help new buyers navigate the road to home ownership. In addition to providing the guidance and support you need, we also offer options to make borrowing for your first home more affordable. Damien loves a good challenge, which has made him Arden's go-to guy for first-time homebuyers since 2010. He loves guiding members through the home buying process and understands that everyone's situation and needs are unique. Now I'll pass the workshop off to Damien.
All right, thank you, Ryan. I appreciate that. And just before we get started, I want to introduce you to the other members of our team, Andy Kossman and also Alicia Lacerda, and they're two of the ones that really help make this mortgage concierge, this first-time homebuyer concierge program, really work for everyone, so that we can effectively guide you through these what can be a challenging time. And really, if you're here, owning a home is really an important goal for you. So maybe it's because you're sick of renting and you're wondering why you're paying all that rent to someone else and you're not seeing any return from it year after year. Or maybe you're living at home now and you don't ever want to rent because you've been told renting is such a bad idea and you don't want to do it for the same reasons as the people that have rented and want to get out of it. But really beyond that, owning a home is a personal thing because it carries with it a sense of permanence and really of belonging somewhere. Because the home is yours. It belongs to you. And you can put your own imprint and personality on it without having to ask your landlord, is that okay? So whatever owning a home would mean to you personally, knowing how to get to that point is really something that can seem complicated and maybe even a little bit intimidating. So tonight, what we're going to do is give you an overview of what's involved so that you can know what to expect. So the roadmap to home ownership is really made up of, we can break it down into 5 different areas. You need to build a strong financial foundation, first of all. After that, you need to understand what home loans are being offered so that you know what your options are for the future and what your monthly payments would look like. There's also shopping for a home and then submitting an offer once you've found one that you like. And then what's involved in closing on your new home, making the transaction complete so that the place is actually yours. So let's start off with building a strong foundation. Now, I'm sure most of you, before you came in here, have heard about the importance of credit reports and credit scores. And it's not an understatement to say that they are crucial to mortgage approval and to what your ultimate interest rate, what you're going to be paying on your loan is going to be. Now, if you've ever wondered why it's so important, I'm sure many of you have had friends or family members that you've known through the years and you can absolutely rely on them for anything. They've always come through for you. So when they ask you for something or they say they're going to do something, you already know it's as good as done because they always come through. It's a little more difficult for a lender to really make that determination about someone that they've never met before in lending them money if they don't have any history with that person or any long-term history. So really what your credit score is showing who you are as far as credit goes, whether or not you've paid your loans back as agreed, whether you're reliable in that regard. Also, whether or not you've overextended yourself or you're handling credit in such a way that you really demonstrated responsibility. And so, again, we emphasize the importance of making sure that your credit history is positive because it's going to impact you not just for home buying, but really throughout your entire life that you're going to need to borrow any money. A good credit score, a good credit history is going to take you a long way. Now let's just briefly talk about what a good credit score would be. In general, the FICO scores range from 300 to 850. So the higher score you have, the better. Now, many mortgage lenders are going to require a score of at least 620, which means if you're in the 600s, you will not have been late on any payments within the last 30 days. Now, if you're a credit score of 660 or higher, that's going to really open you up, though, to more options from more lenders. The lower your score, the different lenders and programs you're going to have to deal with that may not always benefit you in the long term. They may get you what you want in the short term, but then you're going to have to pay for it in the end by some other means. So the better you can get your score before you go shopping for a home, the better you'll be. And there are also non-traditional credit scoring factors where you can opt to have your rent history included on your credit report or insurance and utility payments. They do carry some weight, but not the same as if you have like an auto loan or a personal loan or credit cards that you have paid on a continuous basis. So what could you do to raise your credit score if you feel your credit score is not quite up to snuff or as good as it could be? Well, the first thing would be to make your payments on time. You've already signed on with a creditor saying that you're going to pay as agreed. If you're demonstrating that you are paying monthly as you had agreed to, that goes a long way in demonstrating your reliability. Another thing is to pay down balances. Well, what do we mean by that? Well, with credit cards, just because you have, let's say, a $5,000 credit limit doesn't mean that you should necessarily carry a $5,000 credit balance each month. Use credit as you need to, and if you're able to, make sure that you are able to either pay off the monthly balance in full each month or do it kind of on an installment plan so that your balance is going down each month and not just kind of treading water, because at that point, it can look to a lender and also with your credit score that you're just kind of treading water and maybe you are in a little bit over your head with that. The other thing you want to do is keep older revolving accounts open. So just for clarification, when we're talking about revolving accounts, we're talking about credit cards or credit lines. It's good to pay things off or to have a zero balance. It's not necessarily as beneficial to then close the account out because at that point, you're closing down the credit history for that account and it can impact your score in a negative way because now your oldest trade line may be something you opened last year or last month, as opposed to an account that you've kept open for 5 years, you've had no issues with it, and look, you've handled it responsibly. So if you're able to keep those revolving accounts open and not necessarily use them, that could improve your credit score. You also want to limit your credit applications. So what do we mean by that? Well, there's times that you're going to need to apply for a loan, whether it's a personal loan because a situation has come up, maybe an auto loan, maybe a credit card because there's some type of an incentive associated with it, and you want to take advantage of that. But what you don't want to do is apply for 3, 4, 5, 6 different accounts within a short period of time. And really, when we talk about a short period, we're talking about 12 months. Because the more accounts you open or try to open, those pulls or those credit applications will appear on your credit report as an inquiry. And now a lender that may be you may be applying with to get a mortgage is going to look at that and say, well, they seem to be applying for a lot of credit. What's the reason for that? Is it because they're in some type of financial trouble, they're having difficulty making ends meet, or is there another reason behind it? So it's good to limit your credit applications by the time that you're seriously thinking about purchasing a home. Another good idea is before you purchase a home or before you apply anywhere, that you should check your credit report at least 60 days, 2 months before you apply. And the reason why is because you want to make sure that there's nothing on that credit report that doesn't belong there. So, for example, maybe a collection account from a medical bill you didn't pay 4 years ago suddenly pops up on your credit report. That could impact your credit score and your ability to get the loan that you want. So you want to make sure that there's nothing on there that you weren't planning to be on there. Or if a company, perhaps you did make a payment on time, and for some reason they're reporting it that you paid it late. You can dispute that and have that corrected on the credit report. But you won't know that if you don't know what's on your credit. So a good way to check what's on your credit report without actually applying for anything is to go to annualcreditreport.com. You're entitled to a free copy of your credit report once a year. Now, it's not going to tell you your credit score because it's not based off of credit scoring models. It's just telling you what creditors are reporting about you, and so that you can address any potential issues that may appear on that credit report. As far as knowing maybe in advance what your credit score is before you apply for something, something that a lot of credit card companies are doing now, if you've noticed on your statement, is that they may offer you an option to check your Fico score, so for free, without actually having your credit pulled. So you can take advantage of that because it does not involve a full credit pull. However, the score that they're pulling for you may not necessarily be exactly what another lender is looking for, because there's a different scoring formula for when you're actually applying for credit versus just trying to see what's on your credit report. So just keep that in mind. Most times it's not that vast of a discrepancy, but it will at least clue you in to see if there's anything on that report that you need to give attention to before you go on the home buying road. So the next question would be, in setting that good financial foundation, is how much cash are you going to need? There's things to consider. You're going to have your down payment. You're going to have closing costs, which are the costs that the creditor or the lender is going to charge in relation to helping you to get that loan, because there's certain services that need to be provided in order to underwrite that loan so that they can approve it and then issue those funds. So there are going to be costs involved with that. Then you're going to have costs beyond the actual purchase. You're going to have startup costs, repairs, renovations. You're going to want to get furniture. You're going to want to paint the place probably. You're going to have to probably do something, unless it's a brand new place and it's walk-in and ready to go, and you already had your furniture and everything beforehand. And then you're going to need a rainy day fund. No lender is going to require you to have a rainy day fund. It's just a good rule of thumb, because you're moving into a house in which you are now solely responsible for what happens to it and making any repairs that are necessary and dealing with any unexpected events that may occur. So it's always good to not spend your last dime just trying to get into the house and then find a situation where, I have a major repair to deal with and I don't have any money left to do it with. So those are things to take into consideration. As far as what is allowable for sources of funds for the purchase of a home, you can use your savings account, money that you've set aside. You can use gifts from direct family relations. They can gift you funds for the down payment and closing costs as well. And you can also take advantage of assets. If you have perhaps a retirement account, like a 401k account, you would contact your employer to see how that's set up. But there is the option of being able to borrow on your retirement funds at a reduced rate over a longer period of time that will then allow you to tap into that money for the purposes of making that purchase. So the next step is to get pre-approved. Well, what's involved with that? Getting pre-approved is when you apply with a lender to find out just exactly how much you can afford based off of your income situation, based off of your current debts, and then based off of what your goals are, what it is you're looking to actually purchase. So with a pre-approval, a lender is really looking to establish the most of what you could reasonably afford according to their criteria. And what this will do is it'll allow you to make an offer to a seller that's more compelling because you have a pre-approval letter from a lender who has checked your income, they've checked your assets to make sure you have sufficient funds for down payment and closing costs, and they've checked your credit history, and they've said, you know what, based off of all of these factors, this person would qualify for this loan, and we would be willing to give them a mortgage for this amount. So when a seller gets a letter from your lender saying, yes, they can afford this, it is going to make your offer more compelling because it's not you starting from scratch or them having to take your word for it that, yeah, I can afford this and my offer is legitimate. This actually shows them that, yep, they've done some of their due diligence with a lender's willing to approve them, so we could take this offer more seriously. And this in turn is going to strengthen your negotiating power with a potential seller. Because at that point, you've already proven that you have the ability to get this loan. Perhaps somebody else who's interested may not come with a pre-approval letter or has to go through that process. And the seller decides, you know what, I'm not waiting for them. I have a good borrower or a good buyer right here now. So I'm going to go with their offer. And it also speeds up the home buying process. If you've heard about the current market, not just in this area, but throughout the country, there's a very low inventory and a high amount of demand. People want to buy homes and there's just not enough homes for sale to go around. And so in some cases, you may find a home and you may fall in love with it right away and you want to make an offer that night. You want to get pre-approved before you went out to look at that home, because at that point, the delay in getting a pre-approval, if they're accepting offers only up to a certain point, or if it's at a time where maybe a lender is not able to get back to you right away, you can kind of box yourself into a position where, if only I had done that in advance, I would already be able to make my offer tonight after I saw the home. So it puts you in a better position as far as that goes as well. So now the question is, what can you afford? And that first sentiment on the page, when it says it's hard to enjoy yourself in the house if you can't pay the mortgage, it's very true. And what necessarily a lender will tell you could afford based off of their calculations may not fit what your actual needs are. Well, what do we mean by that? Well, you may have excellent income. You may have very little debt, but you may have to pay $1,500 a month for childcare. A lender is not necessarily going to ask you what you pay for childcare. You know, though, that your budget, if the lender says you could afford $2,000 a month payment, but you know what? It's been hard making ends meet with a $1,500 a month rental payment. You're the one who knows better. You know your individual circumstances better. Don't go by what the lender's saying. This is the maximum you can afford. You need to know your own budget before you get into the situation. So when calculating what a payment would look like, what a housing cost would look like, you really have to understand how a mortgage payment is really separated. With a rent payment, you've got one payment a month, and that's very easy to understand. But with a loan payment, there's a lot of layers to it. There's what you're borrowing. Let's say you're borrowing $100,000. You're going to be making a principal and interest payment on that loan. So you're paying back on that principal of the $100,000, and then the interest on top of that, whatever that interest rate is, whether it be 3%, 4%, whatever the case may be. So you're going to be making those payments, but included is the fact that that house is going to have property taxes. And you have to pay the property taxes because if you don't, the house can be taken away, even if you're paying the principal and interest on the mortgage. So the taxes are a very important factor in calculating what you can afford in regards to a monthly payment. You're also required to carry homeowners insurance. Homeowners insurance is necessary because it's going to replace the house or fix the house in the event that there's any catastrophic damage to it. Otherwise, you'd have to pay all of that out of pocket. And the lender is not going to let you take out a mortgage without requiring that you have a homeowner's insurance policy on the home, in the same way that you have to have an auto insurance policy on a vehicle as well. Also, there's the matter of PMI. Now, PMI is private mortgage insurance. What is that? Basically, if you're putting less than 20% down on a home, most lenders are going to require a mortgage insurance policy to protect themselves in the event that there's ever a default on the loan. What happens with the mortgage insurance policy is that it's included as part of your payment. It's not something optional. It's not something you as the borrower would shop for. The lender has a mortgage insurance company that gives them certain rates, certain premiums, and they tell them, all right, based off their credit score, based off the amount they're putting down, whether it's 3%, 5%, 10% down, this is what it's going to cost for that mortgage insurance, and it's lumped in with that monthly payment. Other things that must be calculated into housing costs are if you're buying like a condo or you're going to buy a property that's part of a homeowners association, whether it's a townhome or whether it's a single family home that's in a development, they may have association dues for the common areas, if they have a pool or tennis courts, or even if it's just an area there where they have like a playground for the kids and it's shared as part of the community property. You're going to have to take those into account as well. Now, those are not included in a mortgage payment, but it's something you would be required to pay separately because they could place a lien against the property if you just didn't pay them at all. So that's something to take into account as well. And then there's the maintenance for the home. What's it going to cost you to power this home? What's it going to cost you as far as your heating bill? So those are things to take into account depending on the type of house that it is and what your lifestyle is as far as what you tend to do as far as energy costs as well. So those are all factors that you should take into consideration before you actually are buying a home and really determining what you can actually afford, in fact. So now let's get into the second part of the road to homeownership, which is understanding home loans. What exactly are the offerings that lenders give you, and how are the payments put together? Now, we kind of touched on this before, and I just touched on this entire thing before about how the loan is broken down. So you have the principal, repayment on the loan amount that you borrowed, then you're paying interest on top of that. So in the beginning, because most homeowners will borrow something between 15 and 30 years on a purchase mortgage, at the beginning of that time, because of how long the term is, a lot of your initial payments are going to go to interest because that's when your balance is the highest, and then gradually it's going to start going down the more years you pay into the loan. It's also likely that you're going to have escrows. Now, escrows are the property taxes, the homeowner's insurance, the PMI, and those are required if you're putting less than 20% down. If you are putting at least 20% down, you may have the option, depending on your lender, of paying the property taxes and the homeowner's insurance on your own as those bills come due each month. But then at that point, it does really require you to be disciplined as far as setting aside those funds each month to make sure that when those bills come due, you're ready to pay them, because they don't make payment arrangements when it comes to those things. So you want to be mindful of that. Now, what types of mortgages are out there? Well, the most popular one, especially in the United States, is the fixed rate mortgage. So what that means is the interest rate and the payment will not change over the life of the loan. It doesn't mean that your overall payment won't change over the life of the loan. And the reason we say that is because your taxes will go up, probably, although there are some cases where they may go down, but they will fluctuate while you own the home. And your homeowner's insurance policy, you may change homeowners providers many times through the years, depending on whether they drop coverage for some reason, they increase coverage, or you've just started shopping around and you found a better rate. So in that sense, the payments can change, but what's not changing is the interest rate and the principal and interest payment that you're making over the life of the loan. Another type of mortgage is the adjustable rate mortgage, or ARM. And what that is, it's a variable rate loan, meaning that the interest rate can adjust after a certain fixed period of time. So let's say you have a 5-1 ARM. What does that mean? Well, the loan payment itself may still be calculated over a 30-year term, but the rate, or the initial rate on that payment, is only fixed for that first 5 years. And then after year 5, the rate can adjust, either up or down, depending on market considerations at that time. Usually the treasury yields from the federal government at that point are the determining factor in what that new rate's going to be. In most cases, an adjustable rate mortgage is going to have the lower initial interest rate versus what a fixed rate mortgage would offer, but it's usually going to increase. And why that is a cautionary tale is because if that rate does increase later on down the line, that may increase your payment enough that you're not able to comfortably afford that payment. Now, the good news is in most cases with adjustable rate mortgages, most lenders today are not charging prepayment penalties, and there's no additional charge for or penalty for refinancing, perhaps into a fixed rate later on down the line. You'll pay closing costs again, but you're not going to incur additional penalty because you got out of that adjustable rate mortgage before 30 years were up. And the same thing with a fixed rate mortgage. You're not obligated to keep the loan for that length of time. You can do things with it, refinance, sell the property, whatever the case may be, before the term is up. But you just want to be mindful of the fact that whatever you do, refinancing, selling, whatever the case may be, then you're going to be subject to whatever the rates are at the time you take that action. There's also a few government-sponsored programs, especially for borrowers who have little down payment money, maybe are veterans, or the property that they're purchasing is in an area that falls under USDA approval, the Department of Agriculture, and also ones who may not have the highest credit score. We talked initially about, it's a good idea to have a 620 credit score. Most lenders want to see that, but 660 is really what's going to open you up to a lot of different options. If you're below that 660 threshold, an FHA loan may be a better option in the sense that they give you very competitive rates, despite the fact that your credit score might be lower. There is a trade-off with that, though, as far as the mortgage insurance. Their mortgage insurance premiums tend to be a little more prohibitive than what we talked about before. And so you always want to compare an FHA option to a conventional mortgage option just to see what would make more sense for you. You can do that with either the lender you apply with, if they're offering both types of options. There's also always a home ownership counseling program or within your area that any lender is provided to or required to provide you with contact information. And they're an unbiased source of opinion that can kind of walk you through the pros and cons of each if you want to get that third-party view and not just go off of what the lender is telling you. So if you're here because you're a first-time home buyer, and what we mean by first-time home buyer is you've not owned a home within the last 3 years. So you could have owned a home before, but if it hasn't been within the past 3 years, then you would still qualify under a first-time home buyer program with virtually any lender. Now with Ardent, a first-time home buyer option allows you to put as little as 3% down, whereas most FHA lenders do require you're putting at least 3.5% down. Ardent also allows you to have some rate protection. So it allows you to actually shop for up to 6 months without getting your pre-approved rate increasing. Now, in the vast majority of cases, lenders do not allow you to lock or hold your rate while you're out shopping. You usually have to wait until you're under contract and you send the lender the contract and apply for the loan before they're willing to actually lock your rate. And even then, your rate is typically only locked for 60 days. Some lenders are as few as 30 days. Others, depending on circumstances, may go up to 90. But 6 months is a pretty substantial period of time. And what rate protection allows you to do is it means that whatever the rate you would have qualified for at the time you got your pre-approval, your rate won't go higher than that, even if overall our rates go higher than that. And if the rates go lower than that, you'd be able to take advantage of the lower rate option as well. And again, this is something that's just for first-time home buyers. And it is with the caveat that that rate is protected so long as you, the borrower, would still meet the requirements from a credit standpoint after 90 days. And what we mean by that is when you apply for a pre-approval, it's good for 90 days because that's how good the credit report lasts. If you wind up purchasing a property or having a settlement date that's past that 90-day threshold, we would need to pull an updated credit report just to verify that everything is still being paid as agreed and to see if anything new has appeared on the report. So you want to be mindful of that, that if your score is still the same or if it's better, you qualify for that better rate. Also, there is an option of having no mortgage insurance payments. And by that, we mean that it would not be included in your loan payment. However, given the past year, especially with what's going on in the COVID-19 environment, a lot of the premiums that lenders have to pay now for mortgage insurance have increased substantially if the lender has to pay for it. So what that means for you is it's cheaper for you to pay the PMI as a borrower than for the lender to pay the PMI for you and increase your rate on however much you're borrowing. It wasn't always that way, but in this current environment, it's usually recommended the borrower paid is the way to go. It'll actually be a lower monthly payment for you. But your lender can go over that, and we can go over that with you just to give you a side-by-side comparison of what we're talking about. And then you can make an informed decision after that. So now we move on to the third part of the roadmap to homeownership, and that's shopping for a home. And as you saw, we were talking about getting that pre-approval first, and it really is important to get a pre-approval before you start going out looking at homes. It's also ideal if you can get that pre-approval before you look for a real estate agent. And we're going to get into some of the reasons for that, but it's still your choice. But if we're talking about order of preference and beneficial for you, the borrower, especially the first-time borrower, it's a good idea to get that pre-approval first. So how do you find a real estate agent that you can trust? Well, you can ask for referrals from family and friends. You can look around, maybe from coworkers who have worked with a real estate agent recently. You want somebody that's familiar with the area that you're interested in. You don't want them coming from somewhere else where they really don't know the area, they don't know the school systems, they really don't know what the neighborhoods are like. You want somebody with experience dealing with what your needs are in the place that you want to purchase. You also want a comparison shop. Not all real estate agents are the same. It's not that difficult to get a real estate license, and I don't mean that in a negative way to anybody who has one. However, not all real estate agents are created equal in that regard. So you can find some really sharp ones, and you can find some ones that may be a little bit out of depth and not best for what your needs are. One point that we do emphasize here, and it's always your choice, but avoid using the seller's agent if at all possible. The reason we say that is because the seller's agent is not looking out for you as the buyer. They're looking out for the seller. So any terms or conditions or anything else that they're discussing with you are with the seller's interests in mind and not your own. And they still are getting the double commission. So at that point, it's really not beneficial for the buyer and the seller to be paying for that essentially through the transaction, but really have only one who is fairly represented. Again, we're not going to be dogmatic about it. It's just a word of caution to anyone that's looking to purchase a home. Get your own agent, someone who's going to look out for your interests. Now, the credit union does offer access to our Home Advantage program. It's a partner offering that we have with Home Advantage that not only allows you to have online tools to assist with your property search, something other than Zillow and what you would typically see online, It also has a network of vetted, experienced real estate agents that the credit union has dealt with and has approved. And the vetting process is pretty stringent, and they're always updating it from year to year to make sure that that agent is still performing top-notch service and has a good reputation in the community. An additional benefit to the Home Advantage program is that that agent who's representing you will actually give you a 20% refund on their commission that you can then take as cash back to put towards your closing costs. And it gives the example here that the average cashback reward for a $200,000 home purchase is $1,200 back on the real estate's commission that you can then put into your coffer for the closing costs and reduce what your out-of-pocket expenses are. So it's not just a few bucks, it's actually a pretty substantial sum. So now we'll talk briefly about the types of homes you can purchase. So there's single-family residences. Those are maybe the standalone homes that are in a housing development. Also, a single-family residence would be considered like a row home, perhaps. Like if you've been in the Philadelphia area, that would be considered a single-family residence, so long as we're not talking about there being a homeowners association involved, which in most row homes is not the case. There's also duplex or multi-unit buildings. So buildings in which there may be 2, 3, 4 units. You as the borrower may decide that you want to occupy one and rent the other 3 out. That is possible that you can do that as a purchase, but there are going to be different down payment requirements on a duplex or a multi-unit property than if you were just buying a single family home, a condominium, or a townhome that was just meant for you. When we're talking about planned unit development, we're talking about properties that are part of a homeowners association. I'll give you an example. My house is part of a homeowners association. It's in a housing development. All the houses are separate. We basically have a sign out front of the development. We pay $11 a month for homeowners association dues. And that's basically what it pays for, is that sign. But that would still be considered a planned unit development. Also, there's condominiums. So condominiums are zoned that way, that they are described as condos, and usually they're either stacked buildings or maybe side by side, and they're just zoned in a certain way. Now, condominiums may carry with them different costs and pricing as far as rates go than if you were to buy a single family home or a townhome, because there are different requirements when it comes to a condominium, because their association tends to be have more thrust upon them as far as responsibility goes. Because with a condominium, basically you own the interior, you own your unit, but the association itself has to take care of the building, maybe the roof of the place that you're in, all the ground that you live around. So there are different requirements and responsibilities associated with that. And so the costs could be a little bit higher on a condo. And then you have townhomes. So those homes that are typically stacked one against the other, they may not have as high association fees. There may be shared common areas, but they are part of a homeowners association. And where that comes into play is that when you're in a townhome, and if you've ever noticed that most of the townhome communities all match, the roof colors are the same, the siding is the same, everything's pretty uniform, well, that's usually a requirement and part of what you pay your association dues for. And so if you want to make any substantial changes, especially maybe to the outside, the coloration perhaps of the home, you may have to go through the association for that. So you don't have 100% say on what's going on with that home. So if that's important to you and you don't want anybody telling you what to do or increasing your dues on a monthly basis because of new services that they provide, then that's just something to take into consideration when you start doing your shopping. And you would make your agent aware of what it is you're looking for. And really, one of the determining factors in finding a good agent is somebody that's honest with you, and it's going to tell you the positives and negatives of everything that you're looking at and whether it fits with what your vision is that you've expressed to them. They shouldn't be trying to shoehorn you into what they think is best. So the next thing you want to do when it comes to home is determining your needs versus your wants. Location, how important is that to you? How important is the square footage of the property? Do you need a big property because you've got a lot of people in it? The age of the home. Do you want something that's newer construction? Do you not mind something that's, 20, 30 years old? Are we talking about something that's turn of the century? And I mean by that 1900s, in which, you may have some other things to take into consideration with that home as far as repairs go. Number of bedrooms, number of bathrooms, how important that is to you as well. The condition of the home, whether it's a fixer-upper or it's move-in ready and nobody's ever lived in it, and you're going to go in and be the first tenant or the first person to occupy it, and there's not a lot of maintenance or new things that you have to worry about going bad with the home. The type and style of the home. Do you want a Cape Cod? Do you want a condominium? Do you want a colonial home? What type of style? You want a rancher, something that's all on one floor? Or do you not mind having stairs and everything? It depends on what your situation is, what the situation of your family is, and what your plans are for the future. Outdoor space, whether you want a yard, whether you want a garage. What type of school system? Do you have kids? Do you want to move into a school system that has a decent reputation, or is that not very important to you because you don't have kids, you're not planning on having kids anytime soon? Or that this is just going to be my starter home, I don't plan on staying here forever, it really doesn't make a difference to me. So these are all things that you would need to make the determination for what is an actual need and what is that'd be nice if we could get it, but it's not as important to me. So what do you do when you're house hunting? Well, there's a few tips here. And the first one is to take pictures and notes to help you remember features of each house. Sometimes when you're looking at a lot of houses at the same time, you may get them mixed up. You may, in your imagination, have fallen in love with one place and realized that actually those features belong to another one. And now you have to kind of either start over or go back to the home to figure out what it is that really struck you about that place. You also want to avoid being distracted by things that are easy to change. And what we mean by that is, if you've ever been to those homes where they have a really nice showing and the interior decorating is just fantastic and it smells like oven-baked cookies when you walk in the door, and it feels like home. But as soon as you buy that place and move in and all the bells and whistles are removed, there's things about it that you didn't quite notice before because you looked at the aesthetics of it. It looked good, but when I think about it, it was just kind of the way that they showed the place and they did a nice job with it. So you want to try and not be as distracted by those things, the curtains, maybe the paint color, maybe even the flooring in some cases. You also want to visit homes more than once before you actually make an offer, because how you feel about a home one day may not be how you feel about a home the next day. So it gives you a chance to sleep on it and really get a sense of if this is really going to be a fit for you and you're serious about moving forward. And this last point, never ever admit that you found the perfect resident. That will totally destroy your negotiating ability, but also it creates a mental block for you in that you're going to do anything you can to get this house because it's absolutely perfect. Guess what? No matter how perfect it is, it's not perfect. There's going to be something wrong with it. So if you keep in mind that I really like the place, but there may come a point where I'm going to walk away, or there's just something about it that goes beyond what I can either afford, what I've budgeted in my mind, or there's something wrong with the property itself that would give you pause and say, you know what, this is going to be more headaches than it's worth. If you go into it with open eyes and a realistic view that it's not perfect, I really like it, I'd like to make an offer on it, but this isn't the end-all be-all of my buying opportunity. So next we get into how do you submit an offer? So what are the components of an offer on a home once you've found one that you like? So you discuss this with your agent. What would be a good purchase price? You're also going to discuss what your anticipated down payment would be, what your loan would look like, so that they would put that on a contract or in an offer, showing the seller that you are serious and that you want to move forward with this option. Some other options that, or some other things that are components of the offer are the closing date. So If they accept your offer, when would the proposed closing date be? Would it be 2 months from now? Would it be next month? These are all things that can be negotiated based off of your circumstances and the seller's circumstances. But it is important to find out what's actually going to work for you. If you still need time to come up with your down payment or the rest of your down payment, or you need time to get out of a lease that you're currently in and you really don't want to pay a penalty on it. These are things that you're going to need to make your real estate agent aware of so that they can put it on an offer. There's also the offer expiration date so that you're not left hanging for a long period of time wondering if they're going to accept your offer, and you're missing out on other properties that you very well could have made an offer on if you knew whether or not they were going to take yours on this one. Another thing that you can ask for as part of the components of an offer is concessions or costs that the seller will pay for you. So this could include cashback for some repairs that may need to be done of a minor nature to the property, maybe an incentive that they can give you towards closing costs where they determine that, you know what, you may be a great borrower, but it may be what their asking price might be a slightly more than you can afford, but if they're willing to make a slight concession, a seller's concession, and help you a little bit with the closing costs, that you would be willing to do that. So some sellers are willing to do that as well. There's also inclusions, what the seller will leave, whether or not it may be some type of an appliance or any furniture that you all agree upon that, you know what, we really like this pool table that you left here, that is here, or could we get the hot tub included with the home? Something along those lines. And if they really don't want to move it and they don't want to be bothered throwing it out, they may say to you, you know what, we'll throw it in as part of the purchase price. And then there's contingencies or conditions that must be met as components of an offer. Really, you do want to protect yourself when you're making an offer. You want to make sure that the offer amount that you're making on the home is going to be equal to what the house actually appraises for. You don't really want to overpay for a house that's not worth what you are paying for it. You also want to make sure that you have a financing contingency. Unless you are willing to be paying cash, $100,000, $200,000, $300,000 from your own savings or from a family member, rich Uncle Jerry that's going to gift you the money, then you better be prepared to have a finance contingency, which means that you're able to walk away from the contract without getting charged anything in the event that for some reason your financing falls through with the lender, such as maybe you had a situation where you lost your job or was reduced income or a family situation came up that required additional expenses, and now the lender says, oh, hold on, you can't afford this anymore. This would allow you to be able to walk away from that deal without incurring any penalties for that. And another condition that should be met is having a home inspection. Now, a home inspection is different than an appraisal, and a lender will not necessarily require you to get a home inspection. An appraisal is really required to determine the market value of the home, what it should sell for, based off of other homes that have been selling in the area over a certain period of time. But a home inspection is more in depth, and it's really for you, the buyer, to understand what the condition of the home is and what potential expenses you may be looking at once you take ownership of the home. For example, how old is that roof? What's the condition of the hot water heater? Is the air conditioner about to go, or is there some life left on it? A home inspector is going to be able to tell you this. They'll be able to tell you if, you know what, it looks like there was a mold problem not that long ago. I'm seeing leakage here. We're going to want to check that out. All things that, if you're aware of it, may either give you pause and say, you know what, I'm not really comfortable making this purchase. I think it's biting off more than I can chew. It's going to be more expensive than I anticipated. Or you can say, you know what, this isn't in peak shape. I know I'm going to have this expense coming. I'm going to have to replace a roof in a few years. Is there any incentive you can give me as the buyer as far as closing costs go? Is there any concessions you'd be willing to give back to me, knowing that I'm going to have to do this because you didn't get this roof fixed or you didn't get this problem fixed before you put it up for sale, but it is going to be an issue sooner rather than later. So a home inspection is a really highly recommended item. And I say that from personal experience. The first home I ever bought, I decided not to pay $500 for a home inspection. And 3 days after we closed on our condo, our air conditioner went, and that cost me $1,200. So you really want to make sure that you're doing your due diligence on the property. Now, a word to the wise in the current market situation that we find. This isn't always the case, but as we discussed beforehand, today's market is very competitive. There's not a lot of homes for sale, and there's too many people that want to buy. So you can get into bidding wars very easily. You may even have a real estate agent say, if you put that appraisal contingency on there, that it's got to appraise for what you're paying for it. Or if you put a home inspection on there, they're not going to accept your offer. That may be the case. But is that worse, not having your offer accepted, but knowing that you're not getting into a bad situation, than getting into a bad situation with a home that now has black mold and needs serious remediation, or has a stucco problem, and now it's going to cost you $100,000 to replace all the stucco in the home because the builder had a leak that they didn't take care of originally? Do you want to get stuck in a situation like that? Is getting a home right now, but getting into a bad situation, better than, you know what, I'm not comfortable with that. Let me take my time with this, or let me find someone who's willing to let me feel good about my purchase and know that I'm not getting the runaround when it comes to purchasing the home that I think that I want and that I'm getting. So now we get to closing costs. And what are these? So these are the fees that are paid to finalize the home purchase. So this is different from your down payment. So your down payment, let's say on a $200,000 home, if you put 3% down, then you're paying $6,000 as far as your down payment. But you're going to have closing costs on top of that. What's included in closing costs? Well, a loan origination fee, which is usually what the lender charges to do the loan. Points, if you're going to be paying to buy down the rate. You do have to have a title search and title insurance on the property. And what that does is ensure that you don't inherit somebody else's problem, a prior owner's problem. And it also insures the lender against any potential liens or issues that may have come up from that prior owner as well. So it is a requirement to make sure that that property is titled in your name and you have a clean slate of ownership going forward. The appraisal for the property to determine market value. A survey determining, what the boundaries of the property itself are and what's actually yours and what actually either belongs to the county or to your neighbor. The recording fees to record all the documents that indicate or that officially put the property in your name as the owner. And then even the mortgage interest that you have to pay when you actually take out the loan as well. So all these costs are included all these services are included in the closing costs. They're usually anywhere from 3 to 5% of whatever that purchase price is going to be. It will vary depending on the property and depending on the loan amount. But if you're talking about having a 3% down payment overall on a $200,000 loan, expect that overall your costs could be closer to anywhere from 6 to 7% when you factor in the closing costs as well. Now, when you make an offer, your real estate agent will present the offer to the seller. Now, it's customary at that time when you make the offer that you're going to put a good faith deposit, and usually that's between 1 to 3% of the purchase price. And it doesn't go directly to the seller, it gets put in an escrow account. And then if for whatever reason the contract is done away with, if both parties agree, you would get that money back. The seller would either accept, reject, or counter that offer. And then once the offer is accepted, it becomes a binding contract, which is why you want those protections as far as the financing, the appraisal, and the home inspection, because you can't just break a contract because you changed your mind the next morning. That could incur penalties. So you want to give yourself as many protections as possible. And then the last stop, closing on your home. So the pre-closing period, usually what we mean by that is from the time that you apply for a loan to the time you actually go to settlement is usually a minimum of 30 days. So during that period of time, a home inspection will be done if you paid for a home inspector. You want to make sure that you check in with the lender periodically. Make sure everything's going smoothly. Good lender's not going to make you check in. They're going to keep you posted on what's going on. But you want to make sure that if they haven't talked to you for 2-3 weeks, you talk to them, because you want to make sure there's no last minute surprises. You want to shop for homeowners insurance? That is something that you are allowed to shop for with any reputable provider, so long as the cost of replacement of the property is basically what you're paying for it. So you can't go cheap on the insurance, but just up to the minimum requirement is what it would cost to replace the property. You want to avoid taking on additional debt if possible. It doesn't mean you can't take out an auto loan or open that credit card while the application is in process, but you better talk to your lender before you do any of those things, because the lender is going to have to take in that new debt into consideration to make sure you still qualify for the loan. If there's going to be more than one owner, you're going to have to decide how to hold title, and you can review those options with the title company themselves. They'll be able to advise you on what each designation there means. And then you'll do a final walkthrough of the property before you go to settlement that afternoon or the next day. They'll allow you to walk through the property to make sure there's no new damage, nothing on there that wasn't there the last time you were in there, and that now needs to be addressed and could potentially jeopardize the settlement. And then finally, the day of closing is the day your mortgage is finalized and that title of that home is transferred to you. Now, before you go to closing, usually 3 days before the closing, you get a closing disclosure from your lender, which is going to detail to you what the final closing costs are going to be. And what you want to make sure when you see those closing costs on the closing disclosure, that they should be similar to what you received in the loan estimate when you originally decided to take the loan with that lender. A lender can't suddenly change the numbers on you and say, oh, there was this expense in that one, and at the last minute you're forced to pay for it. No, they have to give you advance notice, tell you why there would be any changes, and then you have to make a determination if you still want to proceed with that. And when you go to settlement, you're going to sign a mortgage note, which is going to give you the terms and conditions of your loan with the lender. You're going to sign the mortgage or deed of trust, which is going to be recording the property's ownership in your name, and then it's going to be sent to the county and it will be on county record. You'll sign the closing disclosure, acknowledging what the closing costs were, and you'll sign any affidavits indicating, you said this was going to be your primary residence. You said you didn't have a problem with this particular aspect of the property, or so forth, whatever you have discussed with the lender at that point in time. Now, Ardent is now offering, and this is the first time we're doing it, is tonight, our first home concierge service. It is a free service for members, and you would be the first ones to take advantage of it. And it really helps new buyers navigate the road to home ownership. And you'll be able to work one-on-one with our mortgage team. I brought out, it's myself, Andy, and Alicia. And we'll really be able to we're confident we can give you unbiased guidance that you need to reduce your stress and uncertainty. If we feel that there might be another offer out there that's better for you, that doesn't involve you taking money from the credit union or borrowing with us, we'll advise you of that. We want what's in your best interest because you're an Ardent member, and we want to look out for you because we're members too, and we really do care about what we do, and we care that you get into the right situation for you. And then when all is said and done, after an hour of talking and my hoarse throat is pretty much killing me and I need to take a drink, you will be at your new home. So I'm sure there will be some questions. Moderators, I know we kind of just got to the hour mark. Are we going to allow some time for questions, or?
We do have some questions that came in, so we would like to get through a couple of them quickly, Damien.
Okay.
So the first one that came in is, if I am buying a house in a different state, can I take part in Ardent's first-time homebuyer program?
Yes. Ardent lends in every state except for Texas. So the first-time homebuyer program is not just for Pennsylvania.
All right. And our next question is, do buyers pay the 3% commission for their real estate agent, or is the seller responsible for both parties?
Usually it's the seller. it comes from
All
the
right.
proceeds of the sale.
Okay, and we do have time just for one more question. And I believe this question will go to Alicia. What would the process look like if I worked with Ardent's first home concierge?
We we take the time to talk and better understand where you are in the buying process and what you're going to need to learn more about. I also ensure to answer all of your questions that you've had. Then I introduce you into valuable resources available to help you better understand your situation or strengthen it. From there, you also get all the information needed, and we begin to walk you through the process of applying. We bring you this concierge service as a team, so you'll be able to a chance to talk with myself as well as all of my other team members.
All right, and that was our last question for the night. Thank you, Damien and Alicia.
Thank you.
Thank you.
All right. Thank you so much, Damien, for a really informative workshop. If you have any questions that we didn't address in tonight's webinar, please visit ardentcu.org and navigate to our first-time homebuyers page to connect with a member of our first-time home buying team. Lastly, there will be a short survey sent out. We would love to hear your feedback to help us improve for future workshops. Thank you and have a great night.